At 8:02 p.m., one person stepped up to a microphone, read a few calm sentences, and the world's money flinched like it had been hit. Screens turned red. Phones started vibrating. And somewhere, a trader whispered the sentence every market fears. This wasn't priced in. If you've ever wondered how a speech, just words, can erase billions in minutes, you're about to see the machinery behind the panic. And later in this video, you'll hear the exact kind of sentence that flips markets from "everything's fine" to "get me out now." Here's what you need to know before we dive into the chaos. Global markets aren't moved by reality the way normal life is. They're moved by expectations. Not what's happening, but what everyone thinks will happen next. That's the hidden rule that decides what your mortgage costs, what your pension owns, what your savings earn, and whether your job feels secure 6 months from now. And on this night, a single policy speech didn't just change a forecast. It changed the story. Because the market isn't one thing. It's a living ecosystem of bets layered on bets. Stocks priced on future profits, bonds priced on future inflation, currencies priced on future interest rate differences, commodities priced on future scarcity, and derivatives priced on future fear. It's a tower built out of assumptions. And when a policymaker touches one assumption, just one, the whole tower can sway. You'll watch it spread in real time. How a few words hit bond yields first, then currencies, then stocks, then emerging markets, then everything that depends on cheap borrowing. You'll see why the smart money sometimes panics faster than everyone else. And you'll understand the part nobody tells you. The market doesn't crash because people get scared. People get scared because the plumbing forces them to sell. Picture the opening scene. London is still awake. New York is finishing dinner. Asia is preparing to wake up. Liquidity is thin, the way it always is in that awkward gap where the world is handing the trading day from one hemisphere to another. That matters because thin liquidity turns normal moves into violent ones. It's like trying to steer a car on ice. Even a small twist sends you sliding. In a glass tower near the Thames, a risk manager is watching a dashboard that looks like a cockpit. Dozens of columns. Thousands of positions. Calm green. Until it isn't. In Manhattan, a rates trader is half looking at a pre-release transcript, half listening to the hum of a TV in another room. In Singapore, an algorithmic desk has already adjusted its headline sensitivity settings because everyone knows tonight's speech could contain a policy clue. And in a small apartment somewhere, maybe yours, someone is scrolling their portfolio and thinking, "It's been a good year. Maybe I finally caught the wave." That's the dangerous part. Because the wave isn't water, it's leverage. But here's where it gets strange. The speech isn't even supposed to be a shock. It's billed as clarification, guidance, a tidy way to reduce uncertainty, the kind of event that should calm markets. Yet the most destabilizing moments in finance often arrive wrapped in the language of reassurance. The policymaker begins with familiar phrases: commitment, stability, monitoring conditions. The market relaxes just for a second because it hears what it wants to hear: continuity. It wants the story to remain intact. It wants rates to peak soon. It wants inflation to glide down without a fight. It wants the painless ending. Then comes a sentence that sounds harmless to anyone outside finance. Something like, "We will maintain restrictive policy for longer than previously anticipated." 8 seconds. That's all it takes. You could read that and shrug. Longer than anticipated. Okay. But in markets, longer doesn't mean a little longer. It means the discount rate used to value everything is now higher for more time. It means borrowers pay more. It means companies refinance at worse terms. It means consumers slow down. It means the future is worth less today. And the market doesn't wait for the future to arrive. It reprices the future instantly. The first place it hits is bonds, because bonds are basically policy made visible. A government bond yield is the price of money over time. If policy stays restrictive, yields rise, prices fall. That's not drama. That's math. But when trillions of dollars sit on that math, a small shift becomes a quake. On the rates desk in New York, you see it in the 2-year yield first. The 2-year is like a seismograph for central bank expectations. It jumps, not a little, but enough to make someone sit forward in their chair. 10-year yields follow, because long-term money is suddenly being priced in a world where policy doesn't ease as quickly. And then the second-order effects begin, the part that feels like a horror movie where the monster you can't see is already inside the house. Because higher yields don't just hit bonds. They hit every asset valued against risk-free returns. If investors can earn more in safe government debt, they demand more return from risky assets like stocks. That means stock prices must fall unless future profits rise. And profits don't magically rise because someone said restrictive. This is the turning point. The market realizes the old story, easy money, quick cuts, soft landing, may be wrong. And when a story breaks, it doesn't break politely. It shatters. Futures markets start moving before the cash market can even blink. Equity index futures drop in smooth, ominous steps, like an elevator descending too fast. At first, it's a few tenths of a percent, then a full percent, then more. Not because everyone suddenly hates businesses, but because the price of time just changed. What does this mean for you? It means the value of your next decade of returns can be rewritten in minutes by a sentence you didn't even hear. Now watch the next domino, the currency market. This is where the speech becomes global. If one central bank signals higher rates for longer, its currency strengthens because money chases yield. That stronger currency then tightens financial conditions for other countries. Their exports become less competitive. Their dollar-denominated debts become heavier. Their central banks feel pressure to respond. The US dollar, if it's that central bank, rises like a tide. The euro dips. The yen stumbles. Emerging market currencies wobble because investors who borrowed cheap dollars to buy higher-yielding assets suddenly feel the cost of that bet. This is the part nobody tells you. Global markets are linked by borrowing. It's not just trade. It's debt. Somewhere on a hedge fund screen, a carry trade begins to unwind. Carry is the quiet engine of many calm years. Borrow in low-rate currency. Invest in higher-rate assets. Pocket the difference. It works until the funding currency surges or rates spike. Then it becomes a trapdoor. So now you have a multi-asset shock. Yields up, stocks down, dollar up, risk off. And because it's night, liquidity is thinner than usual. A normal sell order becomes a shove. A shove becomes a stampede. But here's where the night turns from sell-off to wipeout. Derivatives. Derivatives are the hidden gears of modern markets. Options, swaps, futures, tools designed for hedging that also amplify moves when everyone uses them at once. And on nights like this, you see the difference between a market with investors and a market with forced sellers. Dealers who sold options have to hedge. If the market drops, their hedge requirements change. Sometimes that forces them to sell more as prices fall, creating a feedback loop. It's like a microphone too close to a speaker. A small sound becomes a screech. Volatility spikes. Not just a little. It spikes because uncertainty has been injected into the timeline. And when volatility spikes, risk models, those supposedly rational guardians of prudence, begin ordering people to cut exposure. Risk parity funds reduce equities when volatility rises. Trend followers flip from buy to sell when key levels break. Value at risk models scream that yesterday's assumptions no longer apply. Margin requirements rise. Suddenly, it's not about what you believe. It's about what you must do. That's the dangerous part. You can be right long-term and still get liquidated short-term. In that London tower, the risk manager's dashboard changes color in patches. A portfolio that looked diversified is now moving like a single animal. Correlations climb toward one, the nightmare scenario, because in stress, everything becomes sell what you can. If you can't sell the worst assets, you sell the best ones. A message pops up, margin call thresholds approaching on several leverage strategies. It's not a moral judgment. It's a mechanical demand. Add collateral or reduce positions. At the same time, a corporate treasurer, somebody whose job is to make sure a company can pay its bills, sees the cost of commercial paper inch higher. They weren't trading stocks. They weren't gambling. But policy moved the price of short-term funding, and now payroll planning just got harder. And somewhere, a homeowner about to refinance doesn't know it yet, but their rate is quietly being recalculated in a chain of pricing that started with a microphone and ended with a mortgage quote. This is why policy speeches matter. They're not speeches, they're switches. Now, imagine the policymaker staff watching this unfold. They can see the market reaction in real time, too. They know what a sudden spike in yields means. They know what a disorderly sell-off can do to financial conditions. And they're trapped in a paradox. If they soften their message, they risk credibility and inflation. If they hold firm, they risk breaking something. Because breaking something isn't a metaphor in finance. It's what happens when a key player can't roll debt, or when liquidity evaporates in a market that everyone assumed would always be liquid. But here's the twist. The speech didn't announce an apocalypse. It announced patience, discipline, a slower pivot. That's all. And yet the market reacts as if a door just slammed. Why? Because for years, markets learned a habit. If pain arrives, policy will rescue. Cut rates, add liquidity, stabilize. That habit became part of the pricing, part of the culture, part of the belief system. And when the policymaker implies, not this time, it's not just a forecast that changes. It's a relationship. That relationship is called the policy put by some traders, a belief that central banks will step in when markets fall too far. On this night, even a hint that the put is weaker triggers a psychological stampede. Not because everyone is irrational, but because everyone realizes everyone else is going to react. Markets are not just math. They're multiplayer games. At 8:17 p.m., headlines ripple across terminals in simplified, sharpened form. The nuance is gone. The careful phrasing becomes a binary. Hawkish, tight, no cut soon. And the most viral version of any policy message is always the scariest one. Because fear spreads faster than careful thought. Algorithms trade headlines faster than humans can read them. A sentiment classifier sees words like persistent, restrictive, not done, and it sells. Other algorithms see the price movement and join. Liquidity providers widen spreads because the risk of being run over is too high. Wider spreads make price moves bigger. Bigger moves trigger more selling. You can almost hear the market's breathing change. Then Asia opens. This is where the night becomes global because now there's a fresh wave of participants reacting, not to the speech itself, but to the damage already done. The Nikkei futures slide. The Hang Seng trembles. Aussie dollar dips. Offshore yuan weakens. Emerging market ETFs gap down because international investors decide they don't want to wake up to a bigger mess. And you, watching from your phone, might think, how is this happening while I'm brushing my teeth? Because money never sleeps, and policy never speaks only to one country. Now comes the silent killer, dollar-denominated debt. Many companies and governments around the world borrow in dollars because it's cheaper and deeper. But when the dollar rises and rates rise, servicing that debt becomes harder in local currency terms. The cost of the debt increases without any new borrowing. It's like your loan payment rising because your salary got cut in half overnight. In some emerging markets, central banks now face a brutal choice. Raise their own rates to defend the currency and risk recession, or keep rates lower and risk capital flight. Either way, the policy speech has exported stress. This is the part that feels unfair because it is. A sentence spoken in one capital can tighten the screws on millions of people who never voted for that policymaker, never benefited from the boom, and now face higher prices and weaker currencies. But markets don't care about fairness. They care about flows. And the flows are turning. Credit spreads widen. That means companies with weaker balance sheets will pay more to borrow. High-yield bonds fall harder than investment grade. Bank stocks get hit because higher rates can help margins but also raise default risks. Tech stocks get hit because their value sits far in the future, and higher discount rates punish far future cash flows the most. This is the dangerous part. The market begins to choose who survives. Now, someone on a trading floor says, "We need to reduce risk." That phrase sounds responsible. It sounds prudent. Sounds like safety. But in a leveraged system, reduce risk often means sell into weakness, which makes weakness worse. And that's how a speech wipes billions off markets. Not because the speech directly deletes money, but because it changes the price at which everyone agrees to hold risk. Remember, markets are auctions. Every price is a handshake between buyer and seller. When policy changes the rules, buyers step back. And without buyers, sellers discover what their assets are really worth in panic. At 9:03 p.m., a major index hits a technical level that traders have been watching, some previous low, some moving average, some line on a chart. In normal times, technical levels are almost superstition. In stress times, they become triggers because so many systems are programmed around them. Break the line and the machine sells. Stop-loss orders cascade. A stop-loss is supposed to protect you, but when many people use them, they become gasoline. The market drops faster. Now the news networks catch up. Anchors speak in urgent tones. They say bloodbath and rout. They show charts plunging. And viewers at home feel a primal fear. The fear of being last. That fear is ancient. In a stampede, you don't die because the lion is chasing you. You die because everyone else is running. This is the turning point for retail investors. Some freeze. Some sell. Some buy the dip because that worked before. But the night's message is different. This dip might not be a dip. It might be a repricing. And repricing is cold. It is not emotional. It is not personal. It is simply the system correcting its own fantasies. But here's what nobody tells you. The biggest losses on nights like this often happen in places you never see on the news. In swaps. In basis trades. In leveraged bond strategies that look boring until they explode. A basis trade, very simply, is betting that two related prices will converge. It's usually low return, so it's often leveraged. Leverage is the accelerant of finance. It makes small profits meaningful and small losses fatal. If yields spike suddenly, the trade can move against you fast. Lenders demand more collateral. You sell to meet the demand. Selling pushes prices further away. Losses grow. That's the doom loop. This is how boring becomes catastrophic. At 10:11 p.m., in a quiet office, someone in a compliance role sees a list of funds breaching internal risk limits. They don't care about narratives. They care about rules. They send an email that reads like a polite execution. Reduce exposure by morning. And so the next day's selling is already being scheduled tonight. What does this mean for you? It means the market is not just reacting to the speech. It's reacting to the reaction. And that second layer is where the big moves come from. Now, consider the policymaker again. They might not have intended to trigger this. They might even believe the market needed to hear it. Because here's the uncomfortable truth. Sometimes markets become addicted to optimism. They price in the best-case scenario, then punish reality when it arrives. Policymakers, on the other hand, worry about credibility. If they blink too quickly, inflation expectations can rise. Wages adjust. Prices stick. And then the problem becomes harder to fix later. Their nightmare is repeating a cycle where premature easing causes the disease to return. So their speech is a signal. We are serious. It is meant to anchor expectations. But anchoring expectations can feel like slamming a hand on a table. And markets hate slam tables. By midnight, the phrase higher for longer becomes a meme in trading chats. People joke because humor is how you breathe under stress. But beneath the jokes is calculation. If rates stay high, what breaks first? Commercial real estate? Over-leveraged tech? A fragile emerging market? A shadow banking product? Something you've never heard of until it's on every headline. This is the dangerous part. The market starts hunting for the weakest link. Because crises rarely start where everyone is looking. They start where everyone assumes stability. A bank somewhere runs a stress test. It models a rapid rise in yields and a drop in asset prices. The model prints a number. The number is uncomfortable. It doesn't mean the bank will fail. But it means the bank will behave differently. It will lend less, tighten terms, hoard liquidity. Multiply that behavior across the system and you get an economic slowdown. This is how financial conditions tighten without any new law being passed. The speech does not need to directly change your life. It only needs to change the behavior of the institutions that decide credit. And credit is oxygen. In the early hours, as the world rotates, commentators begin offering explanations. Some say the market is overreacting. Some say this is healthy. Some say it's a warning of recession. The truth is uglier. The market is doing what it always does when uncertainty hits the policy path, reducing exposure until it can see the road. But the road is never fully visible. It's a fog, and in fog, humans slow down. That's why guidance matters. Policy speeches are attempts to light the road. Yet sometimes the light reveals a cliff. Now we arrive at the climax. The moment the market stops treating this as a bad night and starts treating it as a new regime. A regime shift is when the rules you thought were normal stop being normal. When low rates aren't guaranteed. When volatility isn't temporary. When the rescue isn't immediate. When growth isn't assumed. When the future is no longer a discount, but a question mark. In a regime shift, the assets that led the boom often lead the bust. The most expensive stocks fall hardest. The most leveraged strategies unwind fastest. The most fragile borrowers get cut off. And the strongest balance sheets, boring, steady, cash-rich, suddenly look beautiful again. You can feel the mood change from opportunity to survival. Prices gap. Headlines sharpen. Futures lock limit down for moments. A volatility index spikes like a heartbeat under adrenaline. Bond yields whipsaw as buyers and sellers fight. And the only thing everyone agrees on is uncertainty. This is where you see the real power of a policy speech. It can compress months of adjustment into one night. It can move the market from "we'll deal with it later" to "deal with it now." And that's how billions vanish, not from vaults but from valuations. Because the money in markets isn't stacks of cash. It's the current price multiplied by the number of shares, multiplied by a belief in the future. When belief shifts, the number changes. Feels like loss because it is loss if you needed to sell. But it's also a message. The future just got more expensive. By dawn, the world is talking about the speech. Not the whole speech, just the sentence. The 8 seconds. The calm delivery. The sudden shock. And you might ask, couldn't they have said it differently? Yes. They could have wrapped it in softer words. They could have offered a lifeline. They could have hinted at flexibility. But the entire point of policy communication is to be believed. And sometimes, being believed means being blunt. Now, the most important question, what happens next? In the days after a night like this, markets do one of two things. They either treat it as an overreaction and claw back losses, or they treat it as a re-rating and keep sliding until prices match the new world. The difference is not in the charts. It's in the data that follows and the credibility of the policymaker. If inflation cools quickly, markets will forgive. If inflation sticks, the speech becomes prophecy. If growth holds, it becomes healthy discipline. If growth cracks, it becomes the moment they broke the economy. And the market will rewrite history either way, because markets always pretend the ending was obvious. But here's what you can actually take from this, something you can use. First, pay attention to the path, not the level. Policy isn't just rates are high. It's how long will they stay high, and what will change that. The path determines the discount rate over time, and that's the lever that moves everything. Second, understand that the most violent moves often happen when positioning is crowded. If everyone has made the same bet on cuts, on a soft landing, on low volatility, then a small surprise can trigger a large unwind. The market doesn't move on information alone. It moves on who is forced to change their mind. Third, remember the plumbing. If you see volatility rising and liquidity thinning, moves can amplify fast. That's not doom. It's structure. And when you know the structure, you stop being shocked by the speed. Because the night a single policy speech wiped billions off global markets wasn't magic. It wasn't a conspiracy. It wasn't even a mistake. It was a system built on expectations, leverage, and time, suddenly repricing all three. So the next time you hear a calm voice at a podium, don't just listen to the words. Listen to what the words do. Ask yourself, what story is the market living in right now? And what happens to your money, your job, your future if that story changes in 8 seconds? If this opened your eyes, stay with us. Because the next policy speech is always coming. And the market is always one sentence away from rewriting your world. Like the video, subscribe, and tell me in the comments. If you had to choose, would you rather have short-term market calm or long-term economic stability? Because that trade-off is the real headline, and it's not going away.